You hear all about a company's IPO, right? It gets all the media buzz, the big headlines. But what happens after that? What happens when a company that's already on the stock market needs more cash for its next big idea? Well, that's exactly what we're diving into today.
So just picture it. A company has a successful IPO. Its stock is out there trading, but now it wants to build a new factory or maybe launch a massive expansion. The money from the IPO is already put to work. How do they get that next big infusion of capital? That's the core question we're going to answer.
Here's how we'll break it all down. We'll start with why a company even needs more money after its IPO. Then we'll get into the nitty-gritty of the three main ways they do it: the rights issue, the offer for sale, or OFS, and the follow-on public offer, the FPO. We'll even have a little showdown between the OFS and FPO, and then wrap it all up with what this actually means for you.
Yeah, an IPO really isn't the finish line for a company's fundraising. It's more like the starting gun. It's a huge achievement, for sure, but it's also the beginning of a whole new chapter that often requires even more resources to keep growing.
So, when that need for more cash hits, a public company basically has three main tools in its toolbox. Each one is used for a totally different reason, and understanding the differences, well, it's the key to figuring out what a company is really up to. So let's tackle them one by one.
All right, first up is the rights issue. And honestly, the best way to think about this one is like a company's loyalty program. It's the company turning to its biggest fans, its current shareholders, and giving them a special exclusive offer.
So a rights issue is basically an invitation for people who already own the stock to buy even more of it, and almost always at a nice little discount to whatever the market price is. The crucial part, though, is that it's proportional. The number of new shares you can buy is directly tied to how many you already have.
Now, there are a few things to keep in mind here. It's exclusive, so the general public can't just jump in. And because the company is creating brand new shares to sell, it leads to something called dilution. Think of it like this. If you have a pizza cut into 8 slices and you decide to add 2 more slices, the pizza is bigger, but your original slice is now a smaller percentage of the whole pie. That's dilution.
Let's make this real. Look at South Indian Bank back in 2017. They did a classic rights issue. For every 3 shares you owned, you had the right to buy 1 new one. And get this, the market price was around 20 rupees, but they offered it to shareholders for just 14. That's a 30% discount. A pretty sweet deal for their loyal investors.
Okay, on to our next tool, the offer for sale, or OFS. Now, if the rights issue is like an exclusive club, the OFS is more like a giant open house party. It's a way for the company's founders or big early investors, the promoters, to sell some of their own shares to the public.
Now, pay really close attention to this part because it's the most important difference. With an OFS, the company itself isn't creating new shares or raising money for its own projects. Instead, the promoters are selling a chunk of their personal stock holdings. The money from the sale, it goes right into their pockets, not the company's bank account.
And that leads to some huge differences. An OFS is open to absolutely everyone, not just existing shareholders. And since no new shares are being created, there is zero dilution. The size of the pizza stays exactly the same. This is often used when promoters want to cash out a bit or when they need to sell shares to meet government rules.
And these can be absolutely massive. Just look at NTPC in 2017. The promoters put more than 46 million of their shares up for sale. This wasn't about funding a new power plant. It was about the founders transferring a huge chunk of their ownership to the public.
And that brings us to our final method, the follow-on public offer, or FPO. And you know what? The absolute easiest way to get your head around this one is to just think of it as IPO Part 2. It's almost exactly what it sounds like.
Just like the original IPO, an FPO is all about the company creating fresh, brand new shares and selling them to the general public. And the goal is super straightforward. Raise a whole lot of new money to pump directly back into the business to fund growth and new projects.
And just look at this process. It should look pretty familiar, right? You've got to hire bankers, prepare a detailed prospectus, get it approved, have a public bidding period. It is a very formal, often long, and pretty expensive process. It's a major undertaking, just like that first IPO was.
And they can be incredibly successful. Take Engineers India, for example. When they did their FPO, public demand was so high that the offer was oversubscribed 3 times over. It just goes to show you, when a company has a great story to tell about its future, an FPO can be a really powerful way to get the funding it needs.
All right, it is time for the main event. Both the OFS and the FPO are open to the public, but they are fundamentally different beasts.
So let's put them side by side to really drive home the differences. This is where it all clicks into place.
Let's walk through this. First, look at the purpose. An OFS is for promoters to cash out. An FPO is for the company to cash in. Then, share dilution. With an OFS, you're just transferring existing shares, so nope, no dilution. But with an FPO, new shares are being printed, so yes, dilution is definitely happening. And finally, eligibility. The OFS is a faster track, usually reserved for bigger companies, while pretty much any listed company can go through the long process of an FPO.
And here is the punchline. Ever since the OFS was introduced back in 2012, it's become way more popular. Why? Because it's faster, it's cheaper, and it's simpler than the whole heavy-duty FPO process. This one change has really shifted how companies operate.
So we've waded through all this financial jargon. Why does any of it actually matter to you? Because each of these methods sends a completely different signal about what's going on inside a company. This is your decoder ring.
Here's the bottom line. When you see a rights issue, think of it as the company giving a hat tip to its most loyal investors. When you see an OFS, you have to ask, why are the insiders selling? Is it for a good reason, or is it a red flag? But when you see an FPO, that's a clear signal that the company is in full-on growth mode and needs fuel for its ambitions.
So the next time you see a headline about a company raising more capital, you'll know exactly what to look for. You can see past the jargon and ask the single most important question. Is this move about funding an exciting future for the company, or is it about the founders cashing out their past? And the answer? Well, that tells you almost everything you need to know.